Money and Me on Your Money, only on Money FM 89.3.
Taking a look at news and views that investors care about. Tim Phillips from timtalksmoney.com is my guest. So you're back on TikTok?
Yes, I am. Thank you. I
Hey.
managed to get my account back, so please do check me out at Tim Talks Money SG.
We sure will.
And follow me for more money tips there.
Always.
Yeah.
Listen, I had Walter Dewood in the studio yesterday, and he's the head of Chocolate Finance, and
Yeah.
Chocolate Finance has been in the news, right? Because at first they promised happy returns of 3.3% on the first 20K, 3% on the next 30K, and then a target 3% per annum on any amount above that. And then there was this flood of withdrawals, and they basically had to put a pause on their instant withdrawal facility. And just caught in a blizzard of headlines. Then there were lots of question marks when people had put their money with them, because people are cognizant that this is not a bank, and so it's not covered by the SDIC.
Right.
Should anything happen.
Yeah.
But I was really impressed with Walter coming on yesterday and how upfront he was about Chocolate Finance having been able to meet, I think, 100% of the withdrawal requests for the first 2 days from last week.
Yeah.
So I want to ask you, what do you think of the whole Chocolate Finance debacle?
Yeah, well, I think they were pretty honest in that they made mistakes in the response, in the initial response to withdrawals. So I think it's always easy to sit back from the outside and say this is what they should have done and this is what was wrong. But I think on the ground realities, it's a bit more difficult, right? And especially in a startup environment where maybe you're not so familiar with this kind of crisis. I mean, I told people and friends that if this had happened, this kind of reaction maybe had happened at a massive established bank that had been around for 50 years, like a DBS. This is not right, the way that they responded. But I think you've got to give Walter and Chocolate Finance a bit of the benefit of the doubt, right? They're a bit younger and it's a young company. And I think that kind of reaction maybe they weren't fully briefed on. So I think they understood that and they accepted that they made the mistakes. But I think in terms of meeting withdrawals and calming investors, I think they did a good job at that in the days following, right? So I think in terms of the misunderstanding, a lot of investors seem to think that it was some sort of bank or that
because they hear instant withdrawals.
Yeah, so instant withdrawals. And so they decided that they didn't want to have their money in there because they thought there was going to be some sort of run. But I think there was a massive misconception of what it actually is, right? In terms of your money is being invested into short duration bonds that are investment grade, and you're getting a return on that they're able to provide a liquidity pool for you to withdraw instantly. So all those investments that you have are completely custodized and separated from Chocolate Finance. So there's no way that you would have an actual bank run. I think there's a lot of misleading statements that were made out there about how it was like a bank run, but it was actually, in reality, it's nothing to do with a bank in terms of having your money in a place that maybe is going to go bust, right? Because even if Chocolate Finance did go bust, all your assets would have been custodized with a HSBC or a State Street or some other bank that holds the investments that you're invested into. So when you put money into Chocolate Finance, they put that range of short duration investment grade bonds, and so which are very low to sort of very, very low risk. I think that was the point. And it was a bit of a panic, and people started to... I think there were a lot of people maybe out there that didn't fully grasp what they were actually invested into or what they had their money into. So I think that was the fundamental issue. And so they did a very good job, I think, of meeting all those redemptions, but you have to also understand the liquidity pool they had probably wasn't, as Walter probably outlined, wasn't the size that they needed to meet all those instant withdrawals. So I think there were a lot of people that were upset with not being able to withdraw instantly. I can't get my money right now. And if that's really important to you, then that's fine, right? But I had made a video on this on TikTok about how I wasn't withdrawing because that wasn't the main selling point for me when I put my money into Chocolate Finance, right? It was more about I wanted to get a return and their yield was attractive, but I knew exactly what the money was going towards. And so the ability for me to withdraw all my money instantly wasn't really, or 20,000, whatever it is, wasn't really that important to me.
I see.
And for some people, maybe it was. And so I think they got very upset with this whole, how it played out. And so I think I can understand both sides. I can see it. But for me, I had always said that I was quite comfortable with what I was investing into and why I wasn't going to withdraw.
We love talking to you because you really help us clarify in layman terms what we're actually investing in. Help us understand also, still on this theme of sentiment, right? Investors want to know how the negative news about CDL, the family drama, has impacted the stock, CDL.
Yes, well, I think this is something that is a bit more prevalent maybe in Asia with family-owned businesses. The whole way that whole CDL saga played out, it was, as I talked about in my newsletter, it was kind of like Succession light, but in in Asia, right? It was more the hit HBO show, but probably without the witty dialogue, I imagine. And so these people that are now CEO, or Sherman, who's CEO, is he qualified to be CEO because he's got the same DNA as his father? I don't know. I personally don't agree with that. But that's also something that a lot of people like. Maybe they like family-owned businesses in Asia. They think, oh, they can plan long-term. But I've always found from my experience looking at shares and stocks coming from the Hong Kong market with property developers, there's a lot of capital they sit on. Their business models are generally broken, or they're in a past era that doesn't really apply to today, right? So a lot of people now, when we talk about growth stocks or stocks that are reliable, they've got recurring revenue streams, they're on subscription basis. You don't have big fluctuations in revenue and lumpy profits and lumpy sales. And if you look at property developers, they're exactly the opposite, right? They have lumpy sales, they've got big revenue streams when they launch a project, but then maybe it's super sparse for however many years or months, and then they make a loss. So all these models, I think, are a bit broken. And to add to the fire, you've also got the politicization of property. I mean, you talk about property, you mentioned property in Singapore, and there is going to be a lot of opinions about how property is rising cost-wise. In Hong Kong, it's so political with property. And so I think it's more of a political hot potato, these kinds of companies. Do I want to be invested in something that could be hit by sentiment if the government slaps a stamp duty on this or slaps a stamp duty on that, or tries to cool the market, right? So I think property developers in general, whether it's Hong Kong, whether it's Singapore, they're always prone to these types of political moves. And for me, that's just an extra headache that you have to deal with as an investor. So you've got the bad corporate governance, you've got the bad business / broken business model, and then you've also got the politicization of the property sector as well. So I think those three things, along with the fact that in general, I find a lot of these family-owned property companies, they don't really share their profits with shareholders. They sit on a lot of cash. They have, they maybe pay a very nominal sort of dividend that they like to say, hey, I'm sharing my profits, but they sit on cash and they say, oh, I'm saving this for maybe an acquisition, or maybe I'm spending it on this or that. And then obviously that never materializes. And so you just have a lot of cash, or you have a lot of wasted capital that doesn't get returned to shareholders. So for me, it's really no-brainer not to own any of these companies. I would never touch them with a barge pole. And so, yeah, I think in terms of how it's impacted sentiment, yeah, it's kind of highlighted, hey, these companies have really deep-rooted issues, and it's become obvious that they might be a momentum play or a turnaround play, short term. Maybe, I can hold it for a bounce of 3 weeks, a month. Do I want to hold this any longer than 6 months or a year? No way. That's how I feel.
TimTalksMoney.com. That's where you can read more. You can find him on TikTok as well. Should we get inside Singapore's wallet?
Let's do it.
Okay, so we're looking at OCBC's Financial Wellness Index, and there's some things Singaporeans do really well, like save regularly. Right up there, 94 on the score. Managing unsecured debt, yes, in the green. Paying off housing loan, all good. But I thought what was interesting was this risk-taking. So, Singaporeans investing more than ever, but are they truly on track with their financial goals in terms of the risk that they are taking? Despite increased participation, the average rate of return at 0.4%. So what is driving this low return? Is this ultra-conservative portfolio or ultra-diversification?
I think it's the ultra-conservative approach. I think in that same, I think it was 0.4% in 2023, and then it actually dropped to 0.1% in 2024, average rate of
even
return.
lower.
So even lower. And so I think it's more the fact that the average Singaporean, because I think this wellness index actually polled 2,000 people from ages 21 to 65. So we're not even talking about anyone in the sort of, years where they might be actually starting to retire soon, in 55 to 65. You're talking about people from 21. So it's actually a range of ages. And in terms of what I found the most interesting is what level of risk are you willing to take, in terms of, they asked that question. And it was surprising for me to see that it was actually only 7% of respondents actually were willing to take investment risk where they could get 6% or above in terms of their annual rate of return. So for me, that said something about the risk mentality maybe in Singapore. And in terms of moderate returns and risk, sort of 3 to 6%, that was the bulk. It was 59% of respondents were in that bracket. And then low returns and risk, 34%. So I could maybe understand 34% if you're 55 to 65 and you're in the phase where you're starting to wind down maybe more equity exposure and you're thinking, okay, I need to be more conservative. But if you're 21, 25, 28, 30s, there's really no reason for you to be saying, I need to be 80% in bonds or I need an 80-20 split, right? So I think it's in terms of the data, what we've seen in markets. We all know a lot of investors now are saying, hey, I want to go into the US market and buy all the great growth stocks and et cetera, et cetera. But even if you just buy the market, which I've always espoused, I've always championed just people getting exposure. Just get exposure to the market, the broad market, whether it's the S&P 500, whether it's the FTSE All World. Just get stock or equity exposure, because long term, that's where your real returns will come from. And when I talk about real returns, I mean returns after inflation, right? So say your nominal return, say the Straits Times Index last year, for argument's sake, returned 8% and inflation was 2%. Your real return would be 6%, right? So you always have to talk about it on a real return basis, because inflation eats away at our savings and it also eats away at our investment returns, right? So in terms of the real return of Singapore's stock market, so even Singapore from 1966 to I think 2023, the end of 2023, it averaged on a real return basis around 5.4%. So that's good, I think, on an average real return basis from 66 to 2023, right? You're talking a period of maybe just like under 60 years. That's a pretty good return, real return, I think. Obviously, you look at the US, there's a longer data set that goes back to 1900. From 1900 to 2024, the average, the sort of average annualized real return for US stocks was about 6.6%. So Singapore's not that far off. But I think it just shows you that long run, you really need to have some equity exposure. When I talk about equity exposure, I just mean either broad market in the world or even Singapore. So I think in that sense, there's a lot of people that saying that, they're in T-bills, they're in SSBs, but those yields are dropping. You're starting to see that now, right? They're starting to drop. So you can't be in those, I think, forever, or you're going to get your inflation starting to eat away at that
Well, that's what you're seeing now. And I think that's part of the reason why you're seeing this dumping of money into S-REITs almost. I think last week or the week before, it was a really good week for S-REITs.
Yeah, so I think people are starting to see, with the Fed especially being pretty dovish in its last FOMC, that maybe there's the prospect of, 2 rate cuts. That's what they're saying for this year. That will be good for S-REITs, obviously. But we also need to take that with a pinch of salt in terms of, is that how it's going to play out? Again, the Fed is always very data dependent, looks at inflation, looks at the labor market, looks at, and was talking about tariffs. What is that impact going to be from tariffs? They're going to watch that closely. So I think we need to take that into account. But if, on the whole, if we're in an environment of rates coming down gradually, not fast, but coming down gradually, that's still going to mean rates here on T-bills and on SSBs will also decline. And so that's something that right now isn't a worry at this point. But it's still definitely down from its highs in early 2024, late 2023, right? When I think SSB
3 points.
SSB yields were pretty good and T-bill yields were really, really good. So it's come down, and so it could continue, and it will continue to come down if rates, start to moderate more.
And so since 43%, according to this survey, the OCBC Wellness Index from 2024, since 43% of Singaporeans say they invest in fixed income securities or bonds, where do you think all this is going to go? If at all, people decide,
I think it's, again, this is not financial advice, but I just look at people's allocation, right? You've got to think about asset allocation. Obviously, speak to a certified financial planner, understand what your risk tolerance is, because everyone's going to be different in terms of their risk. But one of the things that has been a lot more discussed in recent years probably has just been the prominence of gold, right? Gold as a percentage of your asset allocation. And it shouldn't be big. I mean, you see people saying they're 80% in gold. And so I think those kind of people think the world's going to end tomorrow, right? Or 100% in gold.
Wow.
So those type of people are like, yeah, okay, you really go live in a bunker in a forest somewhere. But if you're actually like realistic and you think, okay, I want a little bit of diversification and a little bit of hedging from inflation, you'd think bonds are the obvious diversifier, right? But gold also adds a little bit of a different flavor to that. And I think for most portfolio constructors, an allocation of anywhere from 5% to 15% of an overall portfolio of your net worth of assets is something that's sensible with gold, right?
Okay.
And so gold tends to outperform in periods of higher inflation. But long run, the actual real returns of gold aren't that great. So that's something you also have to take into account. So there are periods of outperformance, but longer term, it's not an asset that appreciates a lot or versus maybe stocks, right? And so bonds, you're talking about them having a very close correlation, right? Gold, bonds, and also rates, they would move together generally. But in terms of 2022, rates moved up really fast, right? And bonds got crushed. But gold actually moved out of that correlation, actually started to rise. So it was an interesting environment for gold to actually outperform in 2022 versus when bonds got absolutely killed. And so it tells you a little bit about maybe the era that we're entering into, maybe a bit more geopolitical uncertainty, the US dollar not being so dominant in the next 25, 30, 40 years, whatever it is. And a lot of central banks just starting to stockpile gold a lot more, right? They're starting to buy up gold. It's more of an asset that's decentralized. It's almost like a physical version of the whole Bitcoin case, right? Bitcoin's decentralized. It's not fiat currency. So in that sense, gold is the physical version of it. There are a lot of similarities when you hear Bitcoin bulls and gold bulls talk about their asset class, right? And so there are a lot of similarities that are striking. So I don't agree technically with the whole inflation hedge on Bitcoin because we saw that was totally not true. I think Bitcoin is more of a sort of a beta play on tech, right? I mean, if you see tech go up, Bitcoin goes up. If you see tech get crushed, Bitcoin tends to get crushed. So it's not really sort of moving in line with gold so much, whereas gold is more, I would say, more defensive.
Interesting. So I'm going to turn now to another big report that we were discussing, and this showed us after 125 years of history how markets have changed. And that was a very interesting report. And as I hunt for that, I'm going to share with you the question that I have in mind, Tim. When you look across the trajectory of markets over a century, what delivered long-term outperformance and which styles have failed miserably?
Well, I think mainly it's been equities. I mean, we all know equities has outperformed long-term. If you look at the U.S., as I said, 1900 to 2024, average annualized real return of 6.6%, nominal returns of 9.4% per year, right? So that's pretty amazing on a nominal basis, and then average real return of 6.6. If you look at bonds, I think it's like 0.9% annualized over that period. So there have been golden ages for bonds. We know there was that golden age from post-82 when inflation was sort of vanquished by Volcker and the Fed. Up until basically 2022, right? 21, 22, bonds did really, really well. And so I think that period of ultra low inflation helped. And so there are always going to be periods where bonds do well, and then periods where stocks do well. And so I think
what era are we in now?
Well, that's it. I think you don't.
And by the way, this is the UBS Global Investment Returns Yearbook in case you want to read along.
Yeah, and it's the whole point, I guess, on that is just don't take the view on perhaps country returns or thinking about what particular asset. But if you look at the asset returns over the 20 years, even 25 years for this century, it's more as though you need to really take into account the fact that if you're going to deal with inflation that's potentially higher, you need to also understand that equities will deliver that over 10, 15, 20 years, right? If you're retiring, I think it's very different if you're retiring in 5 years, within 5 years or 10 years, because you don't have that time horizon to say, hey, I can ride it out. So you obviously need to talk to someone about your cash needs, but in general, heading into retirement, you should have about 5 to 7 years of liquid cash for your actual day-to-day living, right? That's generally the advice. And that's good because you don't want to be tapping your investments when you get to 65 if you happen to retire when there's a market downturn, right? You don't want to be selling at that point. So the whole point of bonds is supposed to be that diversifier. But I think as I said, there's been much more of a case for gold because I think gold has actually been the best performing asset this century since 2000 to 2025. Gold has even outperformed stocks. So it's been a pretty impressive run for the yellow metal. And bonds, there's always going to be talk about, they have...
Can I ask you a question on bonds?
Yeah, go ahead.
To what extent is the bond market pricing in a Trump recession as investors protect their portfolio?
Well, I don't think it's actually pricing it in that much because the bond market's pricing in 2 rate cuts, right? So in essence, it's almost like nothing much has changed on the dot plot from December to just the March FOMC just now. So there's a lot of talk about what had happened in February leading into March with all these announcements on tariffs. Everyone's like, the US recession, there's that whole recession thing. And I'm sure if we looked at Google searches, recession would have jumped. I don't know how many times, but it would have jumped a lot. I think the key thing to remember is US economic data actually hasn't deteriorated that much. It's actually holding up. The labor market's weakened a bit. Yes, it came in below expectation, but they still added like 150,000 jobs or something in February, right? So it's not dire. So it's almost like the market is priced in with that correction, but the bond market is saying, hey, everything's cool. What's going on? The bond market is still pricing in 2 rate cuts. Yields haven't completely come down. If you would have thought, okay, the Fed's scared there's going to be a big recession, you would have thought the bond market would have started pricing in some serious Fed rate cuts, but they haven't. Treasury yields are still around sort of like, the 10 years around 3.94%. It hasn't dived. Yield hasn't dived. If you had seen in the recent sell-off, bond yields hadn't moved much, even though stocks cratered, right? And typically, if you think that the Fed's going to cut, then bond yields would have come down and bond prices would have gone up. But that didn't happen. So I think the bond market is really considering this to be a non-event and is waiting to see what happens with the whole tariff situation and if it actually feeds into inflation. There's always talk about out there from economists, from everyone, that this is going to feed inflation. But I think the bond market is waiting for this to actually materialize first because we had that whole it's transitory talk in 2022 with Jerome Powell. And he's saying this isn't transitory. So I don't know if he should have taken that gamble by using those words again, but he's decided he wants to go that route. And so I think it's going to be interesting to see how the data plays out for the U.S. economy in the next few months and whether it is
I have one more
transitory.
question for you.
Yes,
but
go
before
for it.
I turn away from Singapore's wallet, this is a great study, by the way, the OCBC Financial Wellness Index 2024. I just want to let our listeners know, if I peer in the wallet, what are the top 3 sources of passive income of Singaporeans? And they are in order: dividend from stocks, ETFs, and REITs, 65%.
Yep.
And then interest income, that means from bonds and fixed assets and T-bills.
T-bills.
And then number 3 is rental income.
Rental income.
We still love our property.
They love the property.
We love our property. So that's it for your look at Inside Singaporeans' Wallets. But finally, since you're the miles guy, I cannot not ask you this question.
Sure.
Should we use our KrisFlyer miles for Lady Gaga tickets?
Well, technically, my initial instinct would be no, don't do it, because SQ always wants you to use miles for things that are non-flight redemptions, right? Because they get better value from it and you get worse value. But I think when it comes to Lady Gaga, if you can secure it as a KrisFlyer member, because I think there's this KrisFlyer experience where you can actually use your miles to redeem certain categories. If you can get it, and because I imagine it's very difficult to get a Lady Gaga ticket, then I think you should try and use your miles if you can. If you're really intent on going, I think you have to be someone who's a big fan. But if I'm talking about it versus a flight redemption sort of value, it's worse than a flight redemption, right?
Okay, yeah.
But if you're talking about how difficult it is to get tickets, and if you can even redeem your miles for those tickets, then maybe it makes more sense, or it softens the blow a bit. But if you can afford the actual ticket cost, I would probably just go for the ticket cost.
This is why he is our miles guy.
Yeah.
Absolutely fabulous. Now, listen, investors are looking at the Swift effect, Lady Gaga coming in. This is the only concert, like with Taylor Swift, for the region. So the region likely to be descending on our hotels, spending at our eateries. And I guess as an investor, there is no straight line between Lady Gaga coming and, say, hospitality REITs or anything like that. But long term, if Singapore keeps on this strategy of, using music and concerts and being the place where concerts happen in Asia,
Yeah.
what do you think maybe is some interesting sectors to look at?
I think it would probably be last year you had with Taylor Swift, you had the whole UOB thing, right? And I think that was a big sort of boon for them.
Yeah,
I
interesting.
think banks generally in Singapore in the listed space, they are probably ones, if they can strike partnerships with these big acts on cards and just have a regional presence like UOB and DBS, maybe they can start to get more people spending on their cards, right, regionally. I think airlines, I wouldn't say it's going to be there's a massive correlation with like in Singapore Airlines, right? I mean, people, if they're traveling from Southeast Asia, maybe they're going to be taking AirAsia or budget. They're not going to be flying full service Singapore Airlines. So I don't know if Singapore Airlines is going to see an appreciable rise in business from that. I would say, I don't know what you think, Michelle, but like I think Taylor Swift is on some sort of other level. She's like on another level of high,
Economy
right?
boosting
Yeah, economy boosting. So
power.
I think she's got some next level power. Whereas I think Lady Gaga, not to say she's not big, she's big, but I don't think she's going to have the boost that Taylor Swift provided to the Singapore economy.
Interesting.
Yeah,
I'm
yeah.
glad I have this on tape so we can play back and see who's right and who's wrong when it comes to this. I think you're right. Probably in terms of sheer percentages, you may
Yeah.
not see that same impact.
Impacts,
I mean, that's
right.
why Taylor Swift is in the
Is in that
stratosphere that she is, right?
Definitely.
But those are interesting sectors to look
Yeah.
at, and we sure will keep our eyes on them.
Yeah.
Tim, thanks so much for coming by.
Thank you for having me, Michelle.
He's Tim Phillips from timtalksmoney.com. Where can we find you on TikTok?
Tim Talks Money SG. Do give me a follow.
Okay,
Yeah.
will do.
Money FM 89.3.